everybody, my name is Milagros Ibarguren and I'm an economist at the Buenos Aires Grain Exchange. Welcome to this side talk about grain markets world outlook. We have the pleasure and we are very happy to have a panel of experts from Europe and the US who will be presenting their projections for the 2020-2021 campaign and describing the impact of COVID-19 virus on the world grain market. In addition, several issues that are still hot topics in the sector will be touched on as well, like the trade conflict between China and the US and the African swine fever. It is important for us, and we thought that for you as well, to hear what these international guests have to say. And that is because their publications are methodologically rigorous, and also because Argentina is, let us say, a price taker, even though its volume of production is significant. And we have to follow the trend of the world grain market. So we are really excited about this discussion. Allow me to introduce our first speaker. So the first speaker is Arnaud Petit, who is the Executive Director of the International Grain Council. He will tell us about the IGC and discuss its projections. Before joining the IGC, Arnaud was the Director for Commodities and Trade at the Copa Cogeca, which is the European Farmers and Agri-Cooperatives Union. He also led a team that monitored 21 commodities and AU trade negotiations. Arnaud holds a master's degree in agricultural economics from the International Centers for Advanced Mediterranean Agronomic Studies in Montpellier. So, welcome Arnaud, and it is all yours.
Good day to everyone. My name is Arnaud Petit, Executive Director of the International Grains Council. I would like to thank Swam Eurocosta for providing us an opportunity to contribute to the Buenos Aires Grains Conference. I will first of all introduce some words about what is IGC, and then I will focus my intervention about the main factors which would impact the next marketing year. IGC is an intergovernmental body established in 1949 and comprising 56 countries. We do daily monitoring of grains, rice and oilseeds market conditions via circulation of reports and maintaining a web-based information services, as well as we regularly monitor international policy changes in the grain sector. Finally, we do also an annual grains conference, a public forum for all the grain value chain, in order to provide an opportunity for discussions with the policymakers. In terms of information, publicly available are the two big indexes, the GOI, which provide a weighted price index for the main commodities, as well as the GOFI, which is a weekly index for freight costs. Under subscription are available monthly grains reports, and an ocean freight report, which provide you a very good landscape of the information and market development for the main commodities. Then if we look about the COVID-19 and impact of this marketing year, we could see that in terms of seeding area, the COVID-19 had no impact on the Northern Hemisphere, which are leading us to a very good result in terms of harvest, and mainly for maize and soybean, where for wheat, barley and rapeseed, we have maybe a more cloudy perspective. The most important figures is on your left-hand side, where you can see on the last decade, 500 million tons have been added in production worldwide, which show exactly how the farming sector have been able to increase and to improve its techniques and quality. Now, if we move towards the basics or the fundamentals of the wheat market, so for the marketing year 2021, we are still expecting an increased production of 763 million tons, but still some uncertainties about the Black Sea area. But maybe the area where there can be still some move is about the use, and particularly for food and feed. On food, we still expect an increase by 1.2%. But the duration of the pandemic, the consumer behavior and change in tourism could have an impact of the food use. When on feed, definitively, we see the EV maize market having a competition for the feed wheat. And this is why we are still expecting a decrease of 3% in feed wheat prospects. Then in terms of ending stocks, accumulation mostly are in India and China. This is why we are still at record level of stocks for wheat, but I will come back later on that specific point. On trade, due to the fact that the market will focus mainly on food, and some regions have a good production in North Africa, we are still expecting a decrease of trade at 181 million tons, and having Russia regaining its top exporter position. Now on maize, we have a very, very good prospect, except for 3 countries, Serbia, minus 16%, the 7th exporters, South Africa, which is a main importing country, by minus 11%, so we can expect here more export volume, and then Argentina with a minus 11%. Then, what will be the main development in the maize market is a substitution between wheat and maize in the feed ratio. And we see this happening mainly on the top 3 consumers, meaning China, EU, and US. And this change and this shift could be still impacted by the economic recovery, and particularly in China and EU, where the meat consumption can change quickly. So that's something we need to look at in the future, is what's happened on China and EU in terms of meat consumption. On soybean, in short, record in output, supplies, consumption, and trade, and the reason. So very dynamic markets, where the production rebound after, I would say, a dramatic season in US. So now the production is assessed at 373 million tons. In terms of use, we could say also that there is a good rebound in terms of crushing industry, and this is why we expect a plus 3.6%. And in terms of trade, we are still assessing a plus 1% of trade. I would say positive trade, but it's still not in relation to what we had several years ago, where we had the trade increasing by 3-4%. So that's still a recovery, but not necessarily as dynamic as it was in the past. The second main factor for the grain market to monitor is the price at delivery in local currency, so exchange rate. And here you will have 3 slides showing the different impact of this currency movement on the grain trade. In the blue line, so you have the price CNF, so at delivery in dollar, and in red, this is the price in delivery, but in local currency. And you can see for North Africa, for example, we have a different situation when for Algeria plus 6% in local currency, for Egypt, minus 5%. And that's something really we have to look is indeed for Algeria, which is having maybe a good production level, so there will be less demand from that country. To another region, ASEAN region, and here you can see also where Indonesia and Malaysia, typically 2 regions with a lot of tourists, so region impacted more by COVID-19 restriction travel. So you could see here indeed for Indonesia, plus 2% in local currency in comparison to Malaysia, minus 10%, which is mainly supplied by Australia. And then for Sub-Saharan Africa, I would like to pinpoint here mainly the countries which are really dependent to the oil market revenues, and particularly Angola. The exchange rate went down tremendously, and you see the for wheat, indeed, delivery price and local currency plus 15%. So that would have definitively an impact about the demand in different regions of the world. The third factor to analyze and to monitor more closely would be the major stocks for the major exporter. Situation is improving on the main commodities. You see here maize recovering and still high. The wheat stay very high in terms of level of stocks, and even for rice. But what is changing particularly for wheat, the world stock, is indeed if you take out China and India, the stock use ratio is going below at 17%. When you have all the stocks, the stock use ratio is at 39%, which means indeed that we need really to have again, improve competitiveness and productivity from the main exporters country to ensure that the global trade can work. And here again, I would say Argentinian farmers improving the cropping system is very relevant in order to be sure that indeed they can still supply the world markets. And maize, the main element is for China stocks, which are going down for several years. And I would say this marketing year, so we have to see indeed if what will be the harvest for China and maize, and if some government policy will try to replace that level of stocks. When we see all the countries in terms of world stocks, so you see here US with a huge level of stocks in comparison to the past. And we see also that definitely it's a good opportunity for US to be very competitive on that market. Then on trade, indeed, you see for wheat as a consequence of the very weak production in EU, so retreat in terms of export, when Russia will gain definitively for that situation and taking this top exporter position. And for Australia, so you see this big move back in plus 6 to 7 million tons in terms of export, but we have to bear in mind that Australia was 2 years of drought in the past 2 seasons. Then on maize, the trade on maize also, as I said, would be slightly higher, but it's not as it was in the past if you look about the trend in your left-hand side. And the main regions where we would see some changes is, first of all, in Europe, with a larger EU imports amid the smaller wheat harvests. The second is Near East Asia, where Iran can rebound in terms of demand, but also Israel and Saudi Arabia. In North America, Mexico, which is closer to Argentina, is importing more amid reduced stocks. And Canada are able to receive on a bigger outturn. So that's something we have to look for North and Central America. And definitively for Pacific Asia, China, which has been a big buyer recently, with a modest gain in some countries, but smaller deliveries to Vietnam. So that's maybe for Pacific Asia, so China in terms of economic recovery, but what would be also the trend for the imports of maize from Vietnam? Last big commodities, soybean, in terms of trade. So US export to rebound. You know that it's a more simple market in terms of global trade here, as it is between Brazil and US. Brazil, during the first 6 months, exported a lot, even a volume which was not expected from the last marketing year. And I would say now Brazil is more focused on its domestic market and domestic demand, which give a path for US to provide to gain share again, and we expect that US could export 10 million tons more than the previous year. Now the last factor, which is very important also to monitor or to explain some changes in terms of competition, is the freight costs. And you could see that during the COVID-19 period of time, indeed, all these different cost of freight, the difference was a bit teeny. You had also the collapse on the oil market, which had also on having this few difference between the different freights. And after one, now we have more or less recovered, I would say more or less recovered the situation before the COVID-19 crisis. But you see that still the difference is there. And here, for example, between Argentina, Brazil, or Black Sea region. So definitively the freight stay as one of relevant factors when you have this $1 competitiveness. So investment in infrastructure to get this freight cost the lowest possible is still very important. Finally, when we talk about the total cost of trade, I would like also to address a matter about the different share of the cost. And you see, for example, is for wheat, the FOB share is the most important. You have here the graph representing the 50% of the volume traded on the globe for wheat. And the FOB price, meaning the competitiveness of the farmers and the grain value chain, is the most important. And I think for the future, and this is maybe a positive signal for the Argentinian farmers, which are very competitive, which have a very good infrastructure, a very good farm structure also, they can continue to compete on the world markets. The second point here on the graph we can see is on the freight. So you could see there is some changes on the freight, but beyond the freight is also tariffs. And you have in green, indeed, the share of applied tariff, which can move from 0 to 30%, which is still a bit, I would say, for some regions. So definitively, this is something to monitor for the future, and particularly at WTO level. Is there some possibilities to learn some discussion about applied tariff for the grains, and particularly for wheat? I would like to thank again all of you for your attention. I will be very happy to respond to your questions during the Q&A session. Thank you very much for your attention.
Thanks, Arnaud, for your interesting insights. I would like to comment on at least 2 points of your presentation. On the one hand, you made a clear analysis on freight costs and their relevance to competitiveness. It will be key for Argentina to keep investing or to invest in infrastructure in order to get these costs down and to be more competitive in the markets. On the other hand, IGC projections for Argentinian corn productions are consistent with the figures computed by the Grain Exchange. So we all expect less domestic corn production and competitive prices, like Arnaud said, with the US as the main price maker. Every year, Arnaud chairs the annual IGC Grains Conference. The last one covered climate change and sustainability. So, Arnaud, is there any message that you could highlight for the Argentinian producers and companies?
I do believe Argentinian agriculture provides a lot in terms of sustainability. First of all, I should remind Argentina is the only one country in the Southern Hemisphere which can provide such diversity and volumes of grains, which is a huge contribution toward food security worldwide. Second point is about the yields, and if you look about the historical improvement of yields in Argentina, particularly for grains, you could understand how the farming sector has been able to improve its efficiency in terms of inputs. Third point is about agronomics. By introducing GM technology in the agriculture in Argentina, you could see indeed how the farmers have tried to rethink all the agronomics, and it's very incredible and very forefront the way the Argentinian farmers have changed all the agronomic practices to introduce cover crops in the way they are doing and able to keep organic matter in the soil. The third very important point, I would say, is what Buenos Aires Grains Exchange is doing by monitoring remotely the potential harvest. It is really important for all the grain sector, the global value chain, to have a better understanding what's happening here in Argentina. And finally, I would say the transportation system in Argentina is also one of the most efficient. By using the river, Panama River is very important. This is maybe the most efficient way to transport grain environmentally, but also economically. And I do believe that investments in order to keep the same level of fleet and allowing optimizing the use of the big ship in that river will be the most important in the future to be sure that Argentina can trade with all its partners across the world. Thank you very much.
So our next speaker is Mark Jekanowski. Mark is the chairman of USDA World Agricultural Outlook Board, where he is responsible for the monthly forecast of the World Agricultural Supply and Demand Estimate Report, also known as the WASDE. He also serves as program chair for USDA's largest annual conference, the Agricultural Outlook Forum. Mark holds a PhD and master's degree in agricultural economics from Purdue University. And we also have, we also have the honor to have 3 economists at the World Agricultural Outlook Board in the USDA. They are Joanna Hitchner, Seanicaa Herron, and Justin Choe, and they specialize in different products. All of them participate in the production of the monthly WASDE publication. So we welcome Mark, and it's a pleasure to hear from you.
Hello, and greetings from USDA. My name is Mark Jekanowski, and I'm the chairman of the World Agricultural Outlook Board. For those of you who don't know, the World Board is the agency within USDA that publishes monthly the World Agricultural Supply and Demand Estimates Report. And we just released our latest report on September 11th. It should go without saying, I think, that this has been an unusual and complicated year for explaining and forecasting market developments, highlighted, of course, by the global pandemic and the economic lockdowns that ramped up in March and continue to various degrees across the United States and the globe. In the United States, this led to a sharp drop in motor fuel and ethanol demand, for example, as people stopped driving to work and driving to other places as well. And that recovery is continuing, but at a very slow pace today. We also saw major disruptions in our meatpacking industry as many firms shut down temporarily or reduced capacity to deal with coronavirus outbreaks. And while slaughter capacity is back toward normal levels, the level of market uncertainty remains very high as restaurant and food service demand remains depressed, consumer purchasing patterns have changed, and economic uncertainty continues to weigh on domestic and export demand prospects. And aside from the pandemic, it's also important to recall that in February, we entered a phase 1 trade agreement with China with promises to greatly expand US agricultural purchases. And now here we are in September, and we're entering our fall harvest period here in the United States. This year's crops went in the ground, of course, under much better conditions than they did last year. And despite some concerns with recent dryness in parts of the United States and even in some potential early freeze damage in parts of the country, we anticipate relatively abundant harvests of most crops this year. So with that background, I'm very pleased to turn the stage over to three of my colleagues, the real experts on these markets, who will go into much greater detail on the situation and outlook for the commodities they cover. We'll start things off with Justin Choe. He's our feed grains expert who will give us the latest outlook for corn and feed grains in the US and globally, followed by Joanna Hitchner, who will cover the oilseeds complex, and wrap things up with Seanicaa Herron, who will give the outlook for livestock markets. So with that, I'm going to turn it over to Justin. So Justin, please share your screen and the floor is yours.
Once again, greetings. My name is Justin Choe, and today I will be presenting with a focus on the corn complex of the key changes in the latest WSDA report. So this slide shows a summary of the key changes for the most recent WSDA in September. For the US, for the 2020 and 21 crop year, corn production has been lowered by 378 million bushels, which is roughly about 9.6 million metric tons. Also, exports of corn in the upcoming year have been raised 100 million bushels, and domestic disappearance and ending stocks have been lowered subsequently as well. With such changes, our season average price projections have gone up 40 cents to $3.50 per bushel. On the other hand, for world changes, we have expansion in corn in Brazil, as well as increase in exports, and as well as lower production of corn in the European Union. As such, foreign ending stocks are lowered, which we'll go into a little bit more detail in the upcoming slides. So looking at the corn balance sheet for the US, our beginning stocks have been increased slightly on changes of exports and ethanol production numbers from the 2019 and 20 marketing year. For the upcoming marketing year, as discussed earlier, production has been lowered roughly 10 million tons, and feed, seed, and residual and FSI use, or food, seed, and industrial use, have been lowered as well. Offsetting this is an increase in exports, drawing down ending stocks, and lowering the stocks to use ratio to 17.1%. For the world, we have lower production in the world However, this is still a year-over-year increase. Offsetting the drop in the United States is growth in Brazil, which is driven by economic incentives to plant more. Also, some slight increase in India. This is offset by decreases in European Union, mostly Romania, as well as a slight decrease in Ukraine and Russia, which brings down the total world production 8.7 million metric tons. Focusing a little bit on US corn and their prices, we still believe that US remains price competitive compared to other exporters. This is a chart that shows the spread between US corn FOB prices and other key exporters such as Argentina, Brazil, and the Black Sea region. If the values are above the red line of 0, that means US corn is more expensive. If it's under, that means US corn is cheaper. As you can see, starting in the spring of 2020, US corn exports have been price competitive compared to other exporters, and we believe this is a key reason why US corn exports will remain competitive. Even vis-a-vis compared to other feed grains such as barley and sorghum, focusing on coarse grains here, we see that corn continues to be a very price competitive option, especially for feeding purposes. And we expect this to be a main driver of strong competition in the upcoming 2021 marketing year. In conclusion, the key takeaways from the latest WASDE is that we believe competition in the corn export market will continue to be strong. Production has been lowered month over month, but it is still expected to grow year over year. The offsets, the losses in Ukraine in the EU are more than offset by Brazil, and strong global feed and residual demand for corn, such as in key countries like Brazil and China, are expected to continue in 2021. And with a focus on the US corn exports will continue to be price competitive, which we believe that which will drive exports. And with that, that concludes my section of the presentation, and my esteemed colleague, Joanna, will present on the soybean complex.
Thank you, Justin. I will start sharing my slides. So for this outlook, I will begin with demand. In this slide, we see soybean meal equivalent, or SME, consumption growth for China in red and the rest of the world in blue. As you know, China is the world's largest soybean importer with about 60% of the global market import share. And their demand growth for protein meal, which is in red, is expected to stay around 6% in 2020-2021. This is below some of the levels seen prior to ASF and the US-China trade tensions. But we do expect China's SME growth to remain relatively strong, and we also expect more of this growth to come from soybean meal and replace some of the more recent growth in sunflower seed meal and rapeseed meal. As for the rest of the world, we expect protein meal growth to slow as COVID-19 impacts economic growth and demand into the next marketing year. Also important to note, while protein meal growth is expected to expand, importers are holding on to stocks. China and the EU, which account for near 3/4 of imports, have high stocks going into the marketing year. So while consumption is growing, the growth in imports is not expected to be as strong. And as you can see here, global soybean imports are expected to remain relatively flat in the 2020-2021 marketing year. So on to the supply side. USDA forecasts global production to increase 10% in 2020-2021. The growth is mainly driven by a recovery in US production, as well as area expansion in Brazil. For the United States, in red, USDA lowered US production in the September crop production report to 117 million tons, mainly on lower yields in Iowa and Illinois. For Brazil, in blue, USDA is expecting record production of 133 million tons as higher prices and favorable exchange rates drive area expansion. In Argentina, USDA is forecasting 53.5 million tons on slightly higher area and a return to trend yields. So South America is just starting to plant soybeans, and as we can see here, prices are pretty favorable. At the beginning of September, March futures were about 10% higher than last year in dollars per metric ton. And this is already a great incentive to plant more soybeans in South America. However, when you look at March futures in reals per metric ton, it's almost 40% higher than last year. This shows a clear incentive to plant more soybeans and expand acreage in Brazil. And the USDA is forecasting area to expand 5% in Brazil compared to the prior 5-year average of about 3%. So since Brazil is planting now, we will not see that crop until next year. And since Brazilian exports were so strong over the past few months, Brazil will have lower supplies going into the next few months. And we see that the US may have an opportunity to increase exports with the low Brazilian supplies. Here we see Brazil's October 1 stocks in blue, and their combined October through January exports in orange. In general, when stocks on October 1st are low, they tend to, or when they're high, they tend to export more. And since stocks will be low this coming October 1st, we expect the United States to have an opening to increase exports throughout the rest of next year, throughout the rest of this year. This increased demand for the US crop over the next few months is shown in recent high outstanding sales, particularly to China. Here are the outstanding sales, and as you can see, they're historically high for this point of the year. And if these sales turn into exports, which we assume, the US will have a higher export share in 2020, 2021. And here are the forecasted export shares. Brazil and Argentina's shares are forecasted lower, while the US recovers export share, but not quite up to the level seen prior to the China trade tensions and ASF. So quickly on to the products. Soybean meal imports are expected to grow 3% in 2020, 2021. With the largest increases for the EU and Southeast Asia in blue and orange. We also expect imports to increase for Turkey and Egypt. We are forecasting Argentina's export share in black to remain relatively stable. This slide shows global vegetable oil production and consumption, and they're forecasted to grow 2%, with higher soybean oil and palm oil offsetting lower rapeseed oil and sunflower seed oil. Soybean oil production is expected to increase in China and will replace some of the recent food use growth in other vegetable oils. Sunflower seed oil production for Russia and rapeseed oil production for Canada and the EU are down on lower available supplies. So we also expect Argentina to remain the largest soybean oil exporter, with Brazil, the United States, and the EU far behind. On the importer side, India is expected to remain a large buyer, and we also expect China to import more soybean oil to maintain their veg oil consumption growth around 3%. And lastly, while soybean oil stocks remain relatively flat, palm oil and rapeseed oil stocks continue to decline, leading to a 7% decline in veg oil stocks year over year. This tightening market could have an impact on vegetable oil prices moving forward. So with that, I will move on to my colleague, Seanicaa Herron, to go over meat and livestock.
Thank you, Joanna. And I am going to share my screen. Let's start off by looking at the total meat production forecast for 2020 and 2021. Concerning 2020, of course, the elephant in the room, or the issue that's on everybody's mind, has been COVID-19 and the impacts that it has had, not only on the US agricultural sector, but also on the world. So overall, for livestock, particularly cattle, COVID-19 impacted our outlook for the second quarter, where we saw declines in production due to reductions in animal numbers being slaughtered. That was the direct impact of COVID-19 and social distancing measures that were implemented in facilities, as well as some plant closures that took place across the country. And we saw that same trend across beef, pork, broiler, and turkey. However, we also saw higher or heavier carcass weights for livestock and heavier bird weights to help partially offset the decline in animal numbers. So overall, for 2020, our production forecasts are lower than what we experienced or saw in 2019. However, the outlook for 2021 is more favorable, as we anticipate the sectors will continue to adjust to social distancing measures. And as we've seen in recent months, the sectors have had the ability to ramp back up and are close to pre-COVID-19 levels, but not entirely due to social distancing measures. So for 2021, we are forecasting beef production to be higher, a little over 1%, pork about 1%, and broiler and turkey production up 1% also. And if we look at the numbers and we break them out a little bit differently, we'll see beef production is higher, and that's due to higher slaughter numbers as well as heavier carcass weights. We are anticipating continual expansion in the hog sector, which will support higher pork production. And also we are anticipating broiler production to increase over 1% as we see higher numbers, higher bird numbers. Exports. So for 2020, beef exports started out relatively strong. However, reductions in supplies or beef production due to COVID-19, we saw limited availability of products being able to be shipped globally. So we saw some slowdown in exports during the second quarter or the May and June months. However, we have seen some recovery here lately. Pork, on the other hand, continues to be relatively strong, but we've seen some of our minor exporting partners declines there, but strong global demand from China due to ASF reductions in their pork supply has helped to support stronger or firm pork exports this year. And for broiler meat, just a little bit higher here in 2020. And for turkey exports, we've seen such a small decline. However, looking out in 2021, our beef export forecast is expected to recover as supplies become more available. Also, the pork forecast is expected to recover as well on continued support from China and the Hong Kong region. Broiler meat, on the other hand, we're expecting to see some pullback, but not very much. And turkey is expected to rebound or recover. Per capita disappearance. In 2019, we saw record high per capita disappearance. But in 2020, given COVID-19, we saw some disruptions in our supplies and also in our export market. So we did see a decline there per capita disappearance. But looking into 2020, we're still anticipating a small decline, very fractional, at 101.7 kilograms, whereas in 2000, per capita disappearance is projected to reach 101.6 kilograms in 2021, down fractionally from what we are estimating in 2020, which is 101.7 kilograms. Our price forecast going forward, cattle prices as well as hog prices and broiler prices are all lower this year relative to 2019. However, prices are still relatively firm when you look at the 5-year average. Going into 2021, we are anticipating prices to recover strongly for livestock and broiler prices. That's due to, it's twofold. For cattle, it is domestic and international demand recovery. Also for hogs, a similar situation. However, for broilers, we are anticipating higher forecasted 2021 prices due primarily to stronger domestic demand, as we anticipate global demand to be a little bit weaker relative to 2020. And we are anticipating a little weaker prices for turkey in 2021. That concludes my presentation, and I will turn it back over to Dr. Jekanowski.
So thanks, Mark, Joanna, Seanicaa, and Justin for your engaging presentations. Now let's move on to our Q&A round. We are going to start with Joanna. Joanna, as you mentioned in your presentation, the US soybean export trade volume is up and China is the main driver. Do you expect it to return to historical levels that we saw prior to the trade conflict with China? Or if it does not happen, do you foresee an increase in US soybean crushing with any subsequent impact on the Argentina crushing industry?
So the USDA shows a high year-over-year increase for exports in 2020-2021. So it's safe to assume that we expect the trading relationship to return to more historical levels. And you can see evidence of this in our higher export sales, particularly to China in this marketing year. So yes, we do expect exports to China to return back to more historical levels. However, if for some reason those exports don't turn, our export sales don't turn into shipments, we could see more crush in the United States. And if we do have more soybean meal in the United States, there could be downward pressure on prices and we could become more competitive in the export market. Same goes for the soybean oil side. However, we also have in the United States a fast growing renewable diesel sector that could offset some of the increased supplies of soybean oil. So while the US could become more competitive on the soybean meal market, we would have supplies going into the domestic market more on the soybean oil side.
Thank you, Joanna. I would like to comment on something from your presentation. I'm talking about the clear incentive for area expansion in Brazil for corn and for soybean due to higher prices and favorable exchange rates. And the highlight is in exchange rate because in Argentina, the incentives goes in the opposite direction. So moving on, as we know, China is rebuilding its hog herd, but the African swine fever slashed the production by such an amount that's still below historical levels. The protein deficit caused by the epidemic increased China's imports. In particular, in 2020, Argentina beef meat exports are near record levels. So the following question goes to Seanicaa. Seanicaa, how much of the increase in China's import share in the global market is due to the African swine fever? And do you think that African swine fever will continue playing a role in trade?
That's a great question. So overall, demand for imported meat from China remains incredibly strong as a protein deficit caused by African swine fever continues to disrupt trade. Despite the headwinds caused by COVID-19 and disruptions to the global economy, demand growth continues to exceed expectations. China continues to increase its share of the global market deficits in pork, resulting from ASF and shifts in demand to other proteins. So we're also seeing evidence that they're importing more products such as beef and poultry. And as you mentioned, Argentina beef meat exports are near record levels. Altogether, China is expected to account for approximately 28% of imports by major traders, and that's up about 20% from 2019. Despite the rising imports and expanding production of chicken and beef, total consumption in China is expected to decline about 4% this year. So your first question, how much of China's import shares increase in the global market is due to African swine fever? I would say a significant amount of that is due to African swine fever, especially as we've seen those deficits and they are importing more pork from other countries. And recently, the confirmed case in Germany is an example of how now that they have ASF, China has cut them off, has banned them, and so that creates an additional trade flow or disruptions and opportunities for the United States. Do you think the African swine fever will continue to play a role in trade? Absolutely. As things continue to unfold with African swine fever, if there are other cases confirmed and top trading partners, we will continue to see disruptions in trade flows. For some, that creates problems, but for other major trading partners, that creates opportunities, such as the US.
All right, thank you, Seanicaa. Well, Argentina, like the US, should also see this trade disruption as an opportunity. It might, in fact, already be doing so. Well, the following question is about corn. We are seeing that American corn exports are well ahead of past years, which is mainly explained by its large sales to China again. So Justin, even if it is this case, do you foresee more competition between exporters, like Ukraine, for example? Which role would China play?
I think that's a really interesting question. I hope I can answer the question, especially on the China-related part. So yes, it is true that American corn exports are ahead of past years, especially for the new crop on the books or in terms of committed to China. However, one thing to note for background, especially in the audience, is that consistent with established practices, this month WASDE as well only considers those trade actions which are in place or have had formal announcements of effective dates of the time of publication, which means that this report assumes that only policies that are in place. Now, translating this into the China question is that, yes, there is a lot of corn commitments to China for the new crop. However, China still currently has an annual TRQ of 7.2 million metric tons. We have not seen any kind of official indication from the Chinese government or their agencies, such as NDRC, that this TRQ will change. As such, our forecasts for China assume that the China will still import no larger than the current TRQ level, despite other market indicators or movements. So that what role will China play? That will depend on when the official policies change for China, and that will help us update our forecasts. And in terms of competition, as I tried to articulate during my presentation, yes, we do foresee more competition between exporters in the upcoming year for all of the countries that was discussed. I hope this answers your question.
So thank you, Justin, for your answer, and also to clarify the difference between committed sales to China and sales in place or sales having a formal announcement. Justin's answer and his presentation as well supported what we hear from Arnaud, that is the idea that US corn price might be competitive in the next 2020-2021 campaign. That is a takeaway message, especially if Argentina expands its second corn crop. And to close this Q&A round, I have a final question for Mark related to the Phase 1 agreement signed by China and the US. Mark, would you like to share any of your thoughts about the challenges of fulfilling this agreement?
Thank you for the question on the Phase 1 agreement between China and the United States. I'd be happy to speak to that for a few minutes. As you know, I mean, this is an agreement that was signed back in January and went into effect in February with promises by China to purchase about $80 billion worth of U.S. ag products over 2 years, starting in this year. And certainly we've seen, since that agreement went into effect, a relatively strong increase in purchases of U.S. ag products. Got off to a little bit of a slow start, but especially over the past few months, we've seen pretty strong and regular purchases by China, including nearly daily purchases of U.S. soybeans, significant purchases of corn, steady purchase of cotton, among many other commodities that they've also been actively purchasing. So that's, so that's good news for us. We've certainly seen that bump in demand, and that's also been, I think, supporting some of the prices that we've seen here in the U.S. for these commodities, even in the anticipation of further purchases by China. But one thing it's important for people to keep in mind from the standpoint of putting the WSDA report together, the agreement makes it very clear that purchases by China will be at market prices and based on market needs. And that is the way that we think of the agreement. That's the way that we think of the market conditions surrounding the Phase 1 agreement as we put the WSDA together. The Phase 1 agreement itself, it doesn't, we don't use it to shade our estimates one way or the other. Again, it's all just based on market needs. We know there were some commodity-specific targets written into that agreement, so specific targets for corn and for soybeans and cotton, et cetera. But at the board, we actually don't know what those targets are, and I think that's actually a good thing. Again, we look at this from the standpoint of market demand, market needs within China, and the purchase patterns that we observe and the pace to date of China's purchases of U.S. products. And in that sense, we look at China now just like we would look at any other country when we're thinking about their export demand and the implications for demand for U.S. ag products. So really, I mean, with regard to the Phase 1 agreement itself, so what does that mean for us? I mean, basically, we see the Phase 1 agreement as reducing trade and policy frictions, reducing barriers to trade, and kind of normalizing those relationships a little bit more so that China will purchase what it needs from the U.S. at competitive market prices. And indeed, we also know, I mean, just as a matter of fact, the needs within China for agricultural commodities is very large right now. And we've seen that clearly from not only from their increased purchases recently from the U.S. of soybeans, for example, but also their very strong purchases of soybeans from Brazil, earlier this year. So, we know their needs are large as they rebuild their hog herd, as they're trying to rebuild their livestock sector after African swine fever. We know their corn stocks are low. We know their wheat stocks are low. So we anticipate purchases to continue. And given the fact that the Phase 1 agreement really removed a lot of those artificial barriers to trade and improved trade relations, reduced trade tensions between the U.S. and China, we think that U.S. exports will continue to benefit from that. Now, whether or not the actual terms of the agreement will be, achieved exactly, whether they'll actually achieve that $80 billion worth of U.S. ag purchases over 2 years, that's really for the trade negotiators to determine. Also worth keeping in mind that total value includes a lot of different products that at least we here at the World Board don't track very closely things like seafood and fruits and vegetables and other products that are very high value that will also be contributing to that overall total. But when it comes to the basic commodities, we've certainly seen you know, a strong uptick in the amount of sales to China, and I think we can credit the Phase 1 agreement and the resulting reduction in trade frictions for that growth. And given China's needs, we expect that demand to continue and hopefully to continue to grow. So thank you again for that question. I hope it answers. I hope I answered it properly.
So let me thank you everybody who has been watching us online. We hope that you enjoyed this side talk. So see you next year. We hope that we will be able to return to person-to-person interaction the next time we host this meeting. Thank you.